All right, let's get right into it. Today, we're unpacking an absolutely wild day on Wall Street. We saw an AI-fueled rally that pushed the markets to heights we've never seen before. But, and this is the important part, right below that shiny surface, a totally different story was playing out. So, let's dive in.
So, the day we're talking about is Tuesday, October 28th, 2025. And believe me, this is a day that's going straight into the history books. Let's take a look at those closing numbers.
Wow. I mean, just look at this. All three big ones, the S&P 500, the NASDAQ, and the Dow, all of them closed at all-time record highs. The S&P even poked its head above 6,900 for a bit. It was just a spectacular day, driven by this relentless optimism about AI and the feeling that the Fed was about to make money cheap again. But here's the twist. This incredible rally was hiding some pretty serious cracks in its foundation.
Okay, so for our first section, let's do exactly that. Let's peel back the layers on these record highs and take a hard look at those hidden cracks. What was really going on under the hood?
You know, if you wanted to boil the entire day down to one simple slide, this would be it. It's a true tale of two markets. The single biggest positive thing? No doubt about it, a powerful record-setting rally. It was fueled by real excitement around AI and the hope of Fed rate cuts. But the single biggest negative? It's just as clear. This rally was dangerously narrow. Way more stocks actually fell than rose, which tells you the market's foundation is a lot more fragile than those headlines make it seem.
And this right here shows you the problem perfectly. This is what we call market breadth. So, out of all the companies in the S&P 500, only about 108 of them went up. Meanwhile, over 400 went down. I mean, just think about that for a second. The index hits an all-time high, while nearly 4 out of every 5 stocks inside it were in the red. It's just a stunning illustration of how a few mega-cap stocks are doing all the heavy lifting.
And it doesn't stop there. While the big guys were popping champagne, the Russell 2000, which is our barometer for smaller companies, actually fell by over 0.5%. This is a classic sign of what people are calling a K-shaped market. You've got one part of the economy shooting for the stars, while the other part is struggling. The AI giants are just pulling away from everyone else. So what exactly was the fuel for this massive, top-heavy rally? Let's move on and look at the key drivers that lit the fire under this AI engine.
The first, and let's be honest, the biggest driver was NVIDIA. At their big GTC keynote, the CEO, Jensen Huang, dropped a bombshell. He said the company expects to see a staggering $500 billion in cumulative revenue from its new chips by the end of 2026. That number just completely blew Wall Street away and was like pouring gasoline on the AI fire.
And just in case the message wasn't crystal clear, Huang looked right at the bubble fears and shot them down. He said flat out, this is not a bubble, and that the AI boom will keep going for at least another year. You know, when the leader of the whole movement tells you the party's just getting started, the market definitely pays attention.
Driver number 2, Microsoft. The software titan made huge waves by locking in its partnership with OpenAI. The deal includes a commitment from OpenAI to spend a massive $250 billion on Microsoft's Azure cloud services. The news sent the stock soaring, and for the first time ever, its market cap briefly crossed the $4 trillion mark. Just incredible.
Now for a stranger one, a bit of a paradox really. UPS came out with better-than-expected earnings, and its stock jumped nearly 10%. So why the celebration? Well, it was all about aggressive cost-cutting, which included plans to lay off 34,000 employees. And the market saw this not as a sign of a weak economy, but as a good thing, a sign of better profit margins. A truly strange dynamic at play.
You know, this AI boom needs a colossal amount of power, and it looks like the government is stepping in. An $80 billion partnership was announced to build new nuclear power plants, and the goal is specifically to meet the future energy demands of all these AI data centers. This is a huge policy shift and could mean a real comeback for the nuclear energy industry.
And finally, there's the Fed. Of course, with the big FOMC meeting going on, the market has almost completely priced in a rate cut. I mean, look at this. Traders are giving it a 96.7% chance of a quarter-point cut. This expectation of cheaper money is like a powerful tailwind pushing stocks higher, encouraging everyone to take on more risk. So, with all those catalysts in the mix, let's zoom in on the specific companies that really define the day's action. Here are 5 featured stocks that made some serious moves. All right, leading the charge, no surprise, NVIDIA. It jumped almost 5% on that mind-blowing revenue forecast. Then, shifting gears to energy, you have Cameco, a big uranium producer. It surged because it's a direct winner from that new government nuclear power plan. Then there's the efficiency story. UPS soared nearly 10% because of those aggressive cost cuts. Over in fintech, PayPal had a fantastic day, not just with strong earnings, but by announcing a really exciting AI partnership with OpenAI. And of course, the giant, Microsoft, hitting that historic $4 trillion valuation thanks to its massive cloud deal.
Okay, so you're seeing this really complex picture, a super top-heavy market, but with some incredibly powerful themes driving it. So how would you even begin to invest in this environment? Let's break down 3 very different paths you could think about.
So let's walk through these. Path number 1 is all about AI momentum. The idea here is simple. You bet that the AI spending spree continues, and you ride the wave with leaders like NVIDIA. The risk? Well, it's obvious. The valuations are sky high, and you're exposed to any hint of an AI bubble. Path 2 is energy infrastructure. This is a longer-term play. You're investing in the idea of powering the AI boom through companies like Cameco. The risk here is that these projects take a very long time and could face regulatory roadblocks. And path 3 is the value and recovery play. Here, you're betting that eventually the rally will have to get broader. You might use something like an equal weight ETF to capture the rest of the market. The risk is that, well, what if it doesn't? What if that gap between the leaders and everyone else just keeps getting wider?
And that brings us to our final take. How do we square this circle between the absolute euphoria in the market and the much messier reality underneath? Here's what you really need to be watching.
When you boil it all down, there are 2 huge risks to keep front and center. First, extreme concentration. This entire record-breaking market is basically standing on the shoulders of just a handful of giants. If one of them stumbles, the whole thing could get really shaky, really fast. And second, there's this growing disconnect between the market and the real economy. When Wall Street starts cheering for mass layoffs, it signals a really dangerous gap between stock prices and the health of the actual economy.
And that leaves us with the ultimate question, doesn't it? The AI revolution is undeniably real, and these market leaders are incredibly powerful companies. But with such a narrow foundation and this growing detachment from the world most people live in, you just have to ask, is the market standing on the shoulders of giants, or is it teetering on the edge of a cliff? That's the multi-trillion-dollar question to think about. Thanks for tuning in.